I'd like to think that they're already, that they remain dovish because they haven't done anything yet. They haven't tapered their balance sheet at all. They haven't raised rates once. So, fool me once, shame on me. Fool me twice, shame on you. Fool me three times, that's the Fed. So I think they haven't done anything. How many people are really going to get burned by energy? I would say not a lot. But if tech continues to weaken and it's 40% of the S&P and 7 stocks are 26% and 7 stocks are 40% of NASDAQ, I mean, that's where you'd end up being hurt. And besides, the entire business is weighted to owning tech.
We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodjovics. Joining me today is John Roque, Senior Managing Director and Head of Technical Strategy at 22V Research. How are you today, John?
Hey, Tom, I'm doing great. Thanks for having me here. It's a real pleasure to speak with you. Thank you.
Great to have you back on the show. And I know it's been a long time since you were on the show, and this is actually the first time that you and I have had the pleasure of speaking. But in our little conversation here before we hit record, it was pretty interesting, and we have a lot of good stuff to go over today. So I thought we could kind of start by talking a little bit about an article you recently wrote entitled "The Sleeping Giant Awakens." And in it, you said that exact thing, is that we've all said that I'm tired of watching gold and waiting for it to move. So is it truly time to sit up and take notice of gold's behavior in this market environment?
Tom, I think it is important for us to sit up and take notice, if only the fact that gold is now outperforming a lot of key assets on a relative basis. And usually you kind of get that first salvo where gold will turn on a relative basis and kind of, do it almost in disguise where it's improving, but it's not really evident to, let's say, the naked eye, because it's not really doing anything on an absolute basis. But it is showing some relative improvement. And I'll throw one item out there that might be incendiary, but it certainly has improved on a relative basis quite a lot versus Bitcoin. I know Bitcoin is in, gold is not up that much, but that would be just one example. So I do think it's important for us to sit up and take notice.
Mm-hmm. So, John, why do you think that, there's still very few people that own gold? Has it lost its luster in keeping up with inflation over the last 2 years? Or is it possible that gold really front ran inflation with the gains that we saw from 2018 to 2020?
Oh boy, Tom, I got to tell you, I feel like I should see a therapist for what I'm going to say now. So here's the way I think about it. And I know full well, I don't know that I'm going to get this right, but here's what I'm going to say. In the summer of 2019, gold broke out above 1350, and I had a call that I thought gold would make a new all-time high. And it moved to a new all-time high in the summer of 2000. But from 2000 to date, it has been on kind of a slow correcting trajectory. And then over the last several months, it has tried to round off or improve, or what I would call base. So gold was first out of the gate. The other commodities have sort of caught up or participated in what has been a commodity cycle, especially evident since the COVID low of March of 2020. And so I'm encouraged by the commodities participating now, and gold was the lead dog, for lack of a better phrase. I don't know that gold is going to participate because of inflation. I know that it did work well in the 70s and the early 80s in an inflationary environment, but gold also did work fairly well in what was recent memory in a deflationary environment as well. So I'm going to ask myself a question, and I don't know that I have an answer, but here goes. I wonder, Tom, is gold kind of hindered because there are so few people left still managing money who ever really made money being long gold in prior cycles? They're really, and I'm not disparaging anybody who owns it personally, but really for institutional accounts, there might be a handful plus of people still around now who have made a lot of money with gold in prior up cycles. So maybe gold doesn't have that cachet, for lack of a better phrase, in this cycle. Now, I can remember, and this is a long-winded answer, I wrote a note on October 31st of 2001. which seemingly is 1,000 years ago. I know it's only 21, but you get my point. In which I titled the note "Totally and Unequivocally Bullish," and it was about gold, and gold was $280 at the time. And I had the good fortune to have done my due diligence and spoken with anyone that I could find who had had experience owning gold back in the 70s. And at that time, the people who wanted to own gold thought gold would outperform on a relative basis because PEs were so high in the market otherwise, especially tech PEs. They thought that those PEs would come down, stocks would correct, and gold would hold steady. Almost nobody thought gold was going to go up on an absolute basis. So that was pretty lucky. But I don't find in this era that there are the same kinds of people or same kinds of discussions going on for people to own gold here because they are afraid of something else occurring. And that was really the reason in 2001 for gold to start its improvement, is that people were afraid of something else occurring. I don't hear that talk today.
It's interesting that you bring that up, John. And, something I try to do on the show is to try and step outside of an echo chamber, if you will, and really get other opinions about what is going on. So, maybe give us a little bit of an idea of where you're not hearing that gold is favored here, because, most of the people that I talk to really like gold, even though I try to, interview people that don't necessarily hold that view or think that it is not the place that they're looking to protect themselves from, of all things, let's say just inflation.
So I'm going to again go back to 2001 because I think it's just a great lead-in. Back in that time, I went to hear Jim Grant speak, who is the eponymous, editor of the Grant's Interest Rate Observer. I had many lunches and dinners with Richard Scott Ram, who was then the strategist at the World Gold Council. This was before the ETF for gold was released. I went to hear John McElraith speak, who ran at the time the de Tocqueville Gold Fund. I then met John thereafter, many years later, and he spoke. I heard him speak again. I had the good fortune to work with the great investor Jean-Marie Eviard, who ran a gold fund for the first SocGen funds and then the first Eagle funds. We were on the same floor. I went to sit with him many times to talk about gold. And I had lunch with the great Peter Bernstein, who wrote the book, The Power of Gold, which I thought was a great book. I didn't only think it wasn't an academic treatise. It read to me like a novel. And I'll give you an example as to what Jim Grant and some of the others said. I called Mr. Grant after hearing him speak, and I said, Mr. Grant, I would really like to talk to you about gold. He said, John, I don't have time to talk to you. I'm writing a book and I'm beyond my deadline. If you heard my speech, that's what it was. So even a guy like him who wanted to own gold on a relative basis didn't have time for somebody else who was interested in gold. I wasn't offended. It's just the way it goes. But I invited Peter Bernstein out to lunch, and he met me for lunch, and he brought his lovely wife with him at the time. And I said to him, Mr. Bernstein, why did you write The Power of Gold? At that time, I was also writing a column for TheStreet.com. And at the bottom of my column, I would put a trivia question. And whomever answered the question, I'd say, I'll send you a copy of The Power of Gold. And I did. Anyway, I said to Mr. Bernstein, why did you write The Power of Gold? And he said, John, because I hate gold. I said, Mr. Bernstein, I don't understand. He said, John, you were a student of statistics, weren't you? I said, Mr. Bernstein, I likely should have done better, but please go ahead. And he said, John, tomorrow morning, I'm going to come to your apartment. I'm going to ring your bell. I'm going to say, come on down. We'll dress properly. We're going to walk through New York City all day long. It's a beautiful, crisp fall day. We're going to be gone all day, but dress properly. So you come downstairs and you say, let's go. And I say, hold on a second, John. I just want to tell you and make you aware of the risks today. There's a 5% chance you get hit by a car. And so I say to him, well, 95% chance I don't get hit by a car. He said, John, that's right. You proved yourself a student of statistics. However, the ramifications of you being hit by that car are so grave and dangerous, you need insurance. That is gold for your portfolio. So McElraith, Grant, Richard Scott Ram, Jean-Marie Eviard, Peter Bernstein, these were giants in the business. They didn't really think gold was going to go up on an absolute basis. In fact, Peter Bernstein told you he hated it. what's odd now is that the people I speak with are so almost, I don't want to say disinterested, and I don't want to use the word disgusted, but I will just say disappointed in that we have a $9 trillion Fed balance sheet. They are, to use your line, which Jesse Felder said, they are so far behind the curve, they are off the curve.
They can't even see it.
Yeah, the 2-year Treasury yield is at unprecedented heights relative to its own 200-day moving average. Nobody alive or dead has ever seen this kind of action. And there's been speculation, some might not say rampant, but at least speculation across all sorts of asset classes. And yet, gold is sleepwalking. It's not doing anything. And I'm willing to be wrong on this and say, well, it's just a matter of time. It's just a matter of time. And I think it can do it. I think it's set up to do it. But every time it looks like it's ready to take a step, it's like a running back being stopped at the line of scrimmage when he's trying to get a first down. You know, the line collapses on him and he just can't push the ball over the first down marker. That's kind of the way I see gold right here. And most of the people that I speak with in the institutional business kind of just shrug their shoulders and say, I'm just tired of looking at it. It just doesn't do anything. So that's the sentiment read, you know, via my history with gold, my history with those, terrific investors, terrific market thinkers, and where we are today.
So, John, is it possible that, you know, if we take the contrarian view of trying to get outside of where most people are thinking to make capital, that is exactly why we should be excited about gold?
I think that's a very good point. I think that is a good enough reason for us to have it on our screen, to continue to monitor it both on an absolute and relative basis, relative versus other, asset classes, and to create some sort of a level for us to say, if gold gets above here, then that sleeping giant, is going to awaken. And, so just to give you an idea, and I know you know this in your head, I know you know it in your mind's eye, and in your head, of course. But gold tried in November when it went very sharply from 1750 to about 1875, and then it pulled back and created a higher low. And then it built slowly from its December lows until what was its peakable move above 1850 kind of about 5 days ago. And then the Fed spoke and it was just it got shoved right back down again, still to another higher low, and still, kind of with its moving averages. And for the most part, they are positively biased. But I would say that if I'm going to be critical again of myself here, that if it gets above 1850, then I want to add to my position. And if it got under 1750, I would be more critical of me giving it the benefit of the doubt.
Mm-hmm. Something that you and I kind of touched on before we hit record here today, John, was if cryptocurrencies have taken away some of that demand for gold over the past, let's say 10 years or even 5 years, that they've really come in vogue. So what do you think that the effect of cryptocurrencies has had negatively on gold?
I think it's quite easy to buy crypto. I think you could buy it via Venmo. And I think it is kind of an asset for this era, meaning it's immediate. You don't have to call your broker. You could do it on your phone. And I don't believe this, but a lot of people have been convinced that it only goes up. I've heard that young people pay each other via Venmo in Bitcoin because, it only goes up. So, and I think you've also heard that the president of El Salvador has committed a lot of his treasury to Bitcoin. I happen to not agree with that. It's a little weird to me to see a president of a country tweeting about his treasury operations. Mm-hmm. It's a little weird to me to have seen people take their salaries in Bitcoin, which, if you want to talk about contrary opinion, that might be a good one, along with the El Salvador president's decisions. And then, of course, the MicroStrategy position via their CEO, and he actually built a website entitled Bitcoin is Hope. And there are a lot of contrary things to be talked about there vis-a-vis gold, especially since there's this feverish pitch about Bitcoin, and yet it's had a second bear market in less than 12 months. So I think gold has offered more stability than has Bitcoin, although you don't nearly get the attention that you do for Bitcoin with respect to gold, but it starting to outperform Bitcoin might be the first sign. And gold had a double bottom relative to Bitcoin, which if you go back to the autumn of last year, 2 times, and then it's rallied steadily relative. So, but it hasn't broken out on a relative basis to Bitcoin. I think in order for this to happen, gold's going to have to get above 1850 and really show something here.
Mm-hmm. So how do you look at using Bitcoin and related equities as a bellwether to show high PE market conditions, John?
Well, I like to use the IGV as my as a bellwether for high PE market conditions, and that's the iShares Extended Software ETF, IGV, and this has been a pretty good representation of high PE stocks, especially on the software side. And this peaked in November and it came off very sharply. And it's going to rally here, but it's given up a lot. I would think that it's going to be a better idea to sell these stocks on a rally. But there's no way gold is going to outperform this on this bounce here. There's just no way, right? Because this is where the juice is. Mm-hmm. And just to give you an idea, today, this I'm going to put up on my screen here. It's up 3.5% today after being up 4% on Friday. That's big gains, and I can understand why people do want to participate in these rallies. And I didn't do this for this talk, but can I just go over some numbers with you?
Yeah, absolutely.
Okay, so I wanted to prove this to myself because there are an awful lot of analogies that people make with respect to market history. And I think they're all kind of neat to make these analogies, but I never know which one's going to be the right one. So just to give you an idea, if you go to the NASDAQ peak on March 10th of 2000 until its low of October 10th of 2002, there was 649 trading days. Now, the index was down 80% over that time, but I think most people would be shocked to know that there were 305 days that it was up and 344 days that it was down. It's not that big a plurality for down days relative to up days, despite the fact that the index was down 80%. Mm-hmm. And in those 305 days when it rallied, there were 15 rally cycles of at least 12%. I mean, there were some crazy numbers, Tom. It was up 17% over 2 days, the index. It was up 41% over 36 days, 23% over 4 days. I mean, if you took the maximum number of days rallied and the minimum number of days, it's hard to kind of get a feel for this. It was either had a 2-day rally or up to a 75-day rally. But all these rallies, 15 of them, you had at least 12%. So it's quite beguiling and seductive to be, drawn into these rallies because they can be so dramatic. Mm-hmm. So I think this is what, regardless of the PE or regardless of the price to sales multiple, whatever valuation you have on it, if people think they can make money on it for a rally or something a little bit longer lasting, they're going to be involved.
Mm-hmm. Well, I think that's a great point to be able to really force us to step back and look at some of these markets from a more fundamental view and to force us to take that perspective of where these valuations are and where they might be headed. So you are a technical analyst, and one of your, I would say one of your, let's say, favorite tools for analyzing a chart is you're going to have to help me here, John. I read it. Is it the Brobdingnagian base?
Brobdingnagian. The word Brobdingnag comes from Gulliver's Travels. Jonathan Swift made up the word.
Okay.
And we're all familiar with Gulliver, Lemuel Gulliver, traveling to the island of the Lilliputians, and they were the small folk. But he also traveled to the island of the Brobdingnags, and they were the giants. Mm-hmm. And so I just appropriated Jonathan Swift's word, and I made it into an adjective. And a Brobdingnagian base is just a big, giant, sideways action. And if any of your listeners would like to see what I mean, they can go back to the 1970s and take a look at the chart for cotton. And you'll see perhaps the biggest base you've ever seen in your life. Cotton is now coming out above this for the third time, going back to the 1970s. But the prior time it did it, it was ephemeral. It was kind of a 19% move. It went like that. Mm-hmm. And then it more than doubled in its next move. But other than that, this is only the third time it's ever been above this, a horizontal line on this base, going back to the 1970s. So that's a giant base. Nickel looks like it's trying to also break out of a base, LME nickel. And so there are a lot of them. And I just used the phrase, I actually trademarked it, but I just used the phrase just so that it can be associated with me, just to get people associated with big bases. Because I think from big bases come big tenured moves. That's why I use it.
So in a way, I speak to a lot of technical analysts on the show as well. And in a way, we're just building energy for this next move, right?
I think that's a good way to put it. Yes, correct. And I'm going to extend your analogy a little bit and say, if you, Tom, were going to participate in some sort of a powerlifting contest, and today's January 31st, and the contest was in 1 year, you certainly wouldn't be training starting on Thanksgiving in 2022. You'd likely start to train now to kind of build that base or foundation so that come time for your performance, you could perhaps set a personal record or perhaps set a meet record and push to new heights. And that's, you're storing that energy to be used on that most important date. And I think that's the right analogy. Yeah, I agree with you.
So I'd like to go back to something else we were talking about earlier, John, and that's kind of this broader idea for a commodities bull market. In reading some of your reports, I came across one of your kind of comparisons saying that the commodity ETFs are having somewhat of a moment is like saying that Andre the Giant was kind of a big guy. So is this a real understatement in your view at this point?
I think it's a tremendous understatement. If you take kind of right after the low, the commodity index, the Bloomberg Commodity Spot Index has done, remarkably well. I think it's beaten the S&P over that time. It may not have beaten NASDAQ into a NASDAQ's peak, but it certainly beat the S&P over that time. It's remarkable to me that few in our business have noticed that there's been a commodity bull market. I got very lucky in a conference in December of 2020, where I thought that this was going to be an important thing for us to be paying attention to. And I think part of the reason, Tom, is that these are the unintended consequences of an ESG mandate. And that's in two ways. Number one is it forced most of our business to hold more technology stocks than they would have already done, because technology, in essence, solves for the ESG mandate. In fact, if you look at any ESG ETF and put it against the S&P, which is really a tech fund, or put it against NASDAQ, it's really not that different at all. So the consultants have pushed people even more into tech, which creates obviously a greater risk. That's number one. But number two is, I also thought that the ESG mandate, in order to get clean, would result in us not doing enough to get off the already existing demand that we had for the commodities that we use all the time. I mean, we're supposed to go to non-combustible engines, but we haven't done anything to prepare to get off of the combustible engines. We haven't done anything in that regard. And there's a greater demand for nickel or copper or all the metals that go into making these products. So I thought that there was a twofold reason for commodities to have a big advance. And, I kind of would speak to clients about that or investors about that. I spoke to them for a long time. And it was a very difficult sell, for lack of a better phrase, or to convince people to buy, let's say, a stock like Freeport-McMoRan, which actually quintupled off of its March 2020 low into its peak. It quintupled. It was very difficult to get people to say that they, embrace the idea that they should own a stock like Freeport-McMoRan. And so I think the only way, really, that investors would embrace other sectors is really as if tech continues to deteriorate. To me, it can't be tech and, because nobody's going to really want the and if tech's winning. Why would you want and if all you have to have is tech? To me, it almost has to happen if tech does not participate at all. That's, to me, how you probably would get some more investors to identify that there really is something going on here.
Well, that really speaks to kind of the rotation of capital idea out of tech, which has been the major beneficiary of this rally for many years and have that kind of, like I said, rotation of capital into some of these commodities, right?
I happen to agree with you again. I know this is going to sound ridiculous, but we didn't agree on this before we're talking now. So I'll just give you an idea. So I maintain a growth to non-growth ratio. And some would say, well, you mean growth value? And I'd say, I do, but I'm a technical guy, so I didn't want to have to define value. But I could define non-growth by just looking at it. So I'm going to tell you what it is. It's very simple. Anybody could do this. It's the technology ETF, which is XLK, plus the consumer discretionary, which is XLY, that's growth. And the denominator is XLB, basic materials, XLE energy, XLF financials, and XLI industrials. And I created a relative ratio. 2 combined divided by 4 combined, and I plotted that over time, and there's your ratio. So I'm just going to tell you the numbers, because I've had many discussions about this, and I think you're onto something. So from 2008 through 2020, the growth part of my ratio outperformed non-growth part of my ratio in 11 of 13 years. There was a 2-year winning streak, a 5-year winning streak, and then a 4-year winning streak. The 4-year winning streak through 2020, although it did win in 2021 by a little bit. But let's just go through 2020. The 2020 relative outperformance for growth over non-growth was 37%. That's the greatest outperformance over that 13-year period, 37%. The best prior outperformance was 24% in 2015. So not only did growth beat non-growth for 11 of 13 years in 2, 5, and 4-year winning streaks, the greatest outperformance occurred in the very last year of that performance, where it accelerated into its peak. And so I spoke with many people in 2021 who said, I'm looking for one more push here, one more push. And I said, but you got it in 2020. How much more do you think we're going to get here? And in the only 2 years where value, my denominator, where non-growth, my denominator, outperformed, it did it by 44 basis points in 2010 and 10% in 2016. Otherwise, 11 out of 13 years. So it's kind of a birthright or a rite of passage or a religious belief that growth will outperform. And growth really is tech. So nobody in our business is really prepared for tech to underperform. They can't be. And that's not an insult. It's just an observation. You've won for 11 of 13 years. I mean, the Celtics won, I think, 11 of 13 years NBA championships from the 60s into the 70s. The Boston people thought it was a birthright for the Celtics to win all the time, too. But when it changes, it changes. And it usually changes for some length of time. I mean, Boston stunk then until they drafted Larry Bird. So it took a long time.
So, John, as we think about, one of those pieces of the value makeup, we saw in October of 2020, energy makeup of the S&P had fallen to 2%. So are you looking for this trend to really just revert to the mean, or are there more fundamental reasons that you see this percentage rising regardless of the ESG trends against oil?
So I'm going to answer you in a non-fundamental fashion. So it was, like you said, I think it was 2.8% may have been the low. And it's now 3.4%. Energy is now 3.4%. So I'm going to, while we're speaking here, I'm going to try to open my file so that I can speak about this right from the chart itself. But the breakdown level for energy within the S&P 500, where it really kind of lost its strength. And I'm going to tell you right now, Tom, here goes. Okay, I have the file right here. It broke down in 2019 when it got below 5%. From, let's call it 1999 through 2019, the low for energy as a percent of the S&P 500 on a relative market cap basis was 5%. And then in 2019, it broke. And it got to actually not 2.8%, but 2% in October of 2020. So right now, the weighting is 3.4%. I don't know if it's a reversion to the mean, but I certainly think it can get back to 5% of the S&P 500. And I think that would still be a heroic move because it would have come from 2% to get to 5%.
Mm-hmm. So something that you and I were talking about before we hit record today was kind of to do with what we were just talking about as well, is this makeup of these indexes in a way. So we were talking about CPI and the makeup of how they come up with CPI. So you shared with me how the Fed really had hit their 2% target over many decades. So explain to us a little bit about how they were actually hitting that 2% target and they weren't actually ever below it.
Yeah, so if you go back to 1950 and you went, let's say, from 1950 forward, 60 forward, 70 forward, 80 forward, and you get the point. No matter how you look, the average CPI figure was always above 2%. So I don't know what the Fed was trying to prove by saying that they wanted their long-run target to be at 2%. I take it to mean that they're really not paying attention to the data in the Eccles building down in D.C. That's number one. And so, last year, when Jay Powell told us that inflation was transitory, I'm going to say this politely. I got to tell you, it just smacked of him and the 400 or so PhDs in the Fed really just not looking at the data. We've now had 10 months in a row of PPI data on a month-over-month monthly numbers year over year of 6% or greater. 10 months in a row. And I think 8 of the last 9 months have been at 10% or greater. Now, Mr. Powell told us this was transitory, and I knew he wasn't paying attention to the data. And all I did, Tom, was go back to 1950, and I just counted the number of consecutive months that the PPI was above 6%. So in the early 50s, it did it for 11 months in a row. And then in the early 70s, it did it for 31 months in a row. And then in the late 70s into the early 80s, it did it for almost 5 years in a row. And then there was a period in 2007 and 8 where it did it for 12 months in a row. And now we're at 10 months in a row. So inflation certainly is transitory because the rate of change always slows. Mm-hmm. But I thought that he was way too premature to give us the idea that it was at that point. And then in addition, I thought he was also not giving us all the information. And we can say that, he did this for a reason. And, he may have done this for a particular reason. However, if you go back, you'll recognize that in 3 of the prior 4 periods where the PPI was high, and I would say, Tom, not transitory, the S&P went through a bear market. The only time it didn't go through a bear market was in the early 1950s. So another reason why I think gold should be doing better, but yet it's hanging. But the PPI history tells us that the S&P nearly always has troubles when inflation is this high. And I've also thought that while the majority of people in our business were anticipating, as has Ms. Yellen anticipated, as has Christine Lagarde and Mary Daly, and others, that inflation will be lower by the end of this year. I actually think it's going to be higher at the end of this year. And we spoke about this earlier, kind of in a bullpen warm-up, that there was the owner's equivalent rent, which has not yet had its full impact in the inflation figures. I know that's CPI, not PPI, but the point is the same here. Mm-hmm.
Well, that's the thing. That's kind of the point that I was trying to get to, was the makeup of how CPI is calculated really does include a heavy weighting of this owner's equivalent rent, and that hasn't really seen a real change yet. Is that correct?
It hasn't seen a real change, and I would encourage your listeners, if they have a chance, and I think this is just a terrific article. It was written in May of 2021 by Stephen Roach, who was formerly the chief economist at Morgan Stanley, and I would say at the time, he, Barton Biggs, and Byron Wien were kind of the holy trinity of strategy products. He wrote an article entitled "The Ghost of Arthur Burns." It's on Project Syndicate, and he tells you that what happened with the CPI when he was starting his life as a professional economist at the Fed, and how Arthur Burns told them that they were to remove the items that were causing the CPI to move much higher. And Arthur Burns thought to remove them was right because these were exogenous factors. And he thought that Burns was making a big mistake then, and he thinks the Fed is making a big mistake now when they're blaming it on supply chain issues.
So you wrote another article, John, really talking about the actions of the Fed. And it was brought up that the vulnerability of the treasury market could affect the appropriate pace of normalization. So do you think that the biggest thing that the Fed will be taking into account when determining its pace of normalization will be the treasury markets, or will it be when it has seen enough pain in the stock market?
Oh, that's awesome. I think it's the latter. I don't think it's the treasury market at all. It's my humble opinion that the most important price in the world is the S&P 500. Some people will tell us it is the price of money, which of course is the 10-year treasury yield. Some people will tell you it's the euro dollar rate. Some people will tell you something else. I actually think it's the price of the S&P 500. And I think that if the S&P 500 comes under extreme pressure, the Fed will change. There is no Fed chair who wants to end their chairship with an S&P lower than when they started. There's just no way. They are captured by the S&P 500. The Fed is owned by the S&P 500. Mm-hmm. I believe that firmly, and I believe that for a long time. And we can, talk about any sort of white paper results that the Fed puts out, anything we want. But it's my belief, and nobody can change it, that the S&P is the most important price in the world. And if it holds up here, and the Fed starts raising rates, they'll have confidence to raise rates more, or to trim their balance sheet more. Mm-hmm. But if they start and the S&P comes under pressure, then I think their confidence to do that will evaporate quickly.
Do you have any idea of, quantitatively what you mean by coming under pressure? We've seen, a lot of volatility already this year. So do you have any feeling on what that number is going to be for the Fed to turn, dovish again?
Well, I'd like to think that they're already that they remain dovish, because they haven't done anything yet. Mm-hmm. They haven't tapered their balance sheet at all. They haven't raised rates once. So, fool me once, shame on me. Fool me twice, shame on you. Fool me three times, that's the Fed. Mm-hmm. So I think I think to kind of label them as such is a little bit premature. They haven't done anything. Mm-hmm. And so there's been a tremendous amount of internal deterioration that has not yet, to a great degree, been felt by the major indexes. And the reason it hasn't been felt by the major indexes, and I realize NASDAQ was off more sharply than the S&P, is because of the top 7 stocks in the S&P accounted for 26% of the index, and those same 7 stocks accounted for 40% of NASDAQ. And until those items come in sharply, it's probably not likely that the indexes will weaken much more. So I don't know what number will cause the Fed to get concerned about the S&P. But and maybe they do know, but if they didn't know that 7 stocks are responsible for 26% of the S&P, and that tech is 40% of the S&P, and they look at the S&P and say, it's holding up pretty well here. I guess we're moving at the right pace. I wouldn't be surprised if they thought that. Mm-hmm. But I don't know what number is going to cause them to rethink what they haven't really thought yet, or haven't really started. But if you get an S&P rally like you saw today, a big move of 2% today and almost 2.5% on Friday, I mean, I think they're just going to be encouraged to continue to move along as they're doing.
Yeah, and I think that's an important point that you bring up, John. That's worth kind of clarifying a little bit. Is that when we see the concentration of stocks really get very small, and those are the ones that are holding up the indexes like that, that seems to be a very risky point, is it not?
I worked with a guy named Steve Shobin at Lehman Brothers, and he was an excellent mentor. I asked him a million questions, and he answered a million questions. And he always said to me, you always get hurt by the biggest thing. You never get hurt by the smallest thing. So while energy's had a big move, it's still, less than 3% or 3% of the S&P 500. I mean, if it comes in, how many people are really going to get burned by energy? I would say not a lot. Mm-hmm. But if tech continues to weaken and it's 40% of the S&P, and 7 stocks are 26%, and 7 stocks are 40% of NASDAQ, I mean, that's where you'd end up being hurt. And besides, and we went over this a little bit before, the entire business is weighted to owning tech. They're weighted to owning tech. That's where the performance has been. I mean, just consider this. If if you and I were running the Tom and John fund and we had a benchmark weighting of what the S&P tells us it is, which is about 25% of the S&P, but we know because we've done the adjustment that it's really 40% of the S&P, we couldn't outperform if we had only 25% of the S&P. There's no way. We'd have to have a weighting way above where the benchmark weighting is. In addition, how much of our personal accounts are in tech? Not to mention, we've heard of, questionable movements by some of those in Congress, and it's been public as to how much they've traded and what they've traded as well. There's a tremendous tech weighting in our own lives across the board. To see tech come in would be fairly, I would say, more than important and more than debilitating, not only for the business, but I would guess for people's, personal accounts across the board.
So, John, when we think about how you personally look at the S&P, how do you come up with the technical team scoring system when analyzing companies as part of these indexes? What goes into coming up with the scores that you assign those companies?
Okay, I'm going to ask you if you'll indulge me and allow me to maintain this secret. I will tell you, we only have 4 inputs. And so we give it a 0 to there are only 4 inputs, but there's a potential 5 scores because you can have a 0, which you solve for none of the inputs. 1s you solve for 1, 2 you solve for 2, etc. The strongest scores are 3s and 4s, and the weakest scores are 0s and 1s. And I kind of thought this was a neat scoring system. It's not a model by any stretch. It's not a factor by any stretch. It is merely just a scoring system. And it just allows me to kind of get a feel or a sense of what the internals look like for the S&P 500 or any sub-index anywhere. And ideally, you'd love to buy 3s and 4s that are breaking out of a base, or you'd like to buy pullbacks that are 3s and 4s to upward sloping moving averages, and you want to sell 0s and 1s. And I did a study over time. I went back to 1998, and using this kind of 0s and 1s sells and 3s and 4s buys, it works pretty well. So this is something that we maintain, and it helps us along. I think it's just one piece of the puzzle. I still look at all the stocks. I still look at all the charts, just so that I get a better understanding of what the numbers actually are relating.
So when you analyze, most of the companies in the S&P, when you use that framework of analyzing those companies, how weak does the NASDAQ and the S&P look?
Okay, so I'll just give you some recent figures. The weakest, the combined weakest stocks of late, if you took the net, Tom, so if you took strongest minus weakest, the weakest were above the strongest. So I had a net number, it was negative. It was minus 16%. That was the most recent weak total. And just to put it in perspective, I'm not saying it has to get there. I'm just giving you a signpost. The March 2020 low was minus 94%. So, I mean, back then we could have said to ourselves, it can only get to 0. We got to do some buying.
Yeah.
Right. But here it was minus 16%. So we've had a good decline, but I would not say that it has, been protracted or long-lived or, particularly debilitating on a historical basis. It's just been difficult.
Yeah, I know, looking at some of the ways that you've put it together here, though, it looks to be that there was an 84%, let's say 0 and 1 score versus what would it be, 16%, 2, 3, and 4 score that you had. I think that was for the NASDAQ. So that seems overall to be, pointing in the wrong direction for continued buying signals for those companies, right?
So I have these numbers in front of me, and I think they'll be an adjunct to what you and I are talking about. So in February of 2021, 92% of the stocks on NASDAQ were above their 200-day moving averages. So this is Monday, as of Friday's close, this figure was down to 22%. So you lost 70%. Over that entire time, NASDAQ was certainly higher. And certainly higher into its November peak. But as 70% of the stocks in NASDAQ were deteriorating, the index kept going up. So if this were a team, we'd certainly say we don't have all of our best players on the field at the same time. It just made me a little bit more cautious because the internal numbers were deteriorating. And similarly, and this may be hard to consider, but the same indicator with respect to NYSE stocks peaked in December of 2020 at 88%, and its most recent low was 32%. So in more than a year's time, this lost 56 percentage points in the S&P 500. Again, because the S&P was borne aloft by a handful plus of names. So I think it's important to consider these things. And when names get to be this important on a market cap weighted basis in the S&P 500, it probably tells us we're all not as good as stock pickers as we thought we were.
It's an excellent point, John. Of course, you write some very interesting, entertaining articles, like we gave you the Andre the Giant comparison. Those are all available at 22vresearch.com. Is there anything else you'd like to share with our audience before we wrap up today, John?
I don't think so, Tom. We covered a lot of stuff. This was a great talk. Certainly, if anybody has any questions and they want to reach out, they certainly can. I'd love to speak to some people just to get their point of view, because I'd love to hear what others are thinking. I certainly don't have a monopoly on market thought. So it's been my pleasure. If you invite me back, I'll certainly will join you. And thank you so much for having me. And I hope you have a great 2022. Thanks. It was a pleasure to be with you.
Thank you, John. I appreciate your time and your perspective, and we'll definitely have you back again.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.